Hello, hi guys. Alright, thank you and welcome back for another learning video on this channel. Alright, so glad to see you again. Okay, have you watched the previous video about option? Alright, if you have not, you need to actually watch the earlier video before you start on this video, or rather in the next few video about options strategy. Alright, because if you don't know understand the basic about options, you will not be able to actually understand this video or the next few video I'm going to cover about option strategy. Alright, so the link is above. Alright, so if you don't know where to find it, just click on the link above. Actually, it will lead you that video. Watch that video first. Alright, okay, if not, without further ado, let's dive into this week's video. I'm going to share with you how to actually create a source of monthly passive income using option strategy, as well as if you are a stock investor, you want to buy stock, how to actually buy stocks at a cheaper price than the rest of the people in the market. Alright, so without further ado, let's dive into it. Alright, as usual, if you're brand new to this channel, alright, okay, if you like our video, watch our previous videos so far but have not subscribed, alright, please subscribe to our channel by clicking on the subscribe button on the YouTube, right? But also most important, don't forget to actually click on the notification bell button beside it so you will be notified every single time when there's a new video actually upload on this channel. Alright, a quick disclaimer as well as every other video, anything we share on this channel, particularly anything touching on the stocks, tickers, alright, they are just purely for educational purposes. Right, it's not any buy or sell recommendation. Please do your own due diligence before you actually invest in anything. Alright, so in this video, we're going to share with you actually how to use the protective put option strategy to actually help you to make money in the stock market. Alright, so why actually we use protective put strategy? Alright, mainly actually firstly we actually want to look at how can we buy stock share at a lower price than most people are actually looking at, if they are actually buying at the same price that we initially thought we wanted to. Right, and the second thing, actually how to create monthly passive cash flow as a new income stream for you actually profit out of the stock market. Alright, let's dive deeper and let me run through how it works. Alright, so firstly, remember, for you to invest in the stock market, alright, that one, the most important thing that you need to know and to do is actually find a good company with strong fundamental to invest in. Alright, if you are not actually looking for a good company to invest in, alright, you will not be actually investing on for the long run benefit. Alright, anything that is bad, it will just keep going down unless you're looking at the strategy, actually how to actually sell the market, sell the stocks and stuff like that. If not, generally we want to look for good company, strong fundamental to invest for the long term. Alright, so after you find a good company, of course, definitely you need to find where is the good area of entry. Alright, that is the most important because that creates, or rather that actually expands your the probability of success. Alright, so that is something that you want to find out. Typically, there's two ways to actually look at it. One is either you find out what is the intrinsic value, so you only want to find an area of entry where it is at or below the intrinsic value, or if you are more into technical analysis, right, you actually want to find where is the support level when the stock is actually on an uptrend. Right? Then after that, actually you use your strategy. In this case, we're going to talk about put, how actually you want to sell a put option strategy at a specific strike price, right, so that you actually can profit something out of it. Alright, okay, so I want to give you a first example, the one I mentioned earlier, how to actually buy at a lower price. Right, so I'm going to just use this example. They are not real figures, just a ballpark figures that I use it for as an example for illustration. Right, so for example, this company Coca-Cola, currently the share price is $33, just assuming we are in the month of January. Alright, and somewhere along that you actually figure out that, oh, okay, I have done my calculation, I have done my homework, Coca-Cola is a good company, and I found out that based on the valuation, I found out that actually the intrinsic value of Coca-Cola is $30, for example. Alright, so you decided to sell a put option contract at a strike price for 30 and you expires 1 month. Alright, and because you sell the put, as a seller, you actually will collect a premium. Alright, we are actually usually targeting at a 2% or more return ROI in short. So in this case, we are looking roughly about at least a premium collection of 60 cents per share. Okay, so let's say when the price actually dropped to 30 and below, alright, naturally your put option will be exercised. Remember, what is a put option is actually the right to sell, right? But in this case, because we're going to sell a put, we are the seller. So So by definition, as a buyer, you have the right to sell. As a seller, we actually have the obligation to buy. So in this case, if the price has dropped below 30, as a seller of a put contract, we have the obligation to buy from the buyer at $30, right? Okay, so you just take a look. If you were to buy at $30, but because we have collected a premium of 60 cents, net in total, instead of paying $30 in the market, we are actually buying it at $29.40, right? So we are actually buying slightly cheaper than the market. Okay, so it really depends on what is the premium that they collected and what the strike price you're actually looking at. That will actually lowers your entry price by a fair bit as compared to anyone else who actually bought at $30. Alright, so just imagine if me and you have actually bought a share, I bought at $30 straight up, right? Actually, you use a put contract to buy it and you bought it at $29.40, right? Isn't it right to say that if the share price have went down even further but bounced back up, you can easily to break even at $29.40, but I still have to wait for the price to go up to $30 before I can exit with a break-even price, right? So that will actually reduce your risk a fair bit by using a put option to actually buy a stock rather than actually buying outright. Alright, so the other way is actually the second method of using a put option actually is a form of way to help you to actually create cash flow, right? So using the same example for Coca-Cola, let's say the share price currently at $30 in January, right? So as the price moving up, we need to identify the area of entry. So usually if you are more looking into technical analysis for this strategy, right, you want to find where are the support level where the price bounces, right? So just based on this simple example, let's say this is a Coca-Cola chart. So those circles areas are the areas where actually it shows a good area of entry potential, right? So every time when it hits there, what you're going to do, you're going to sell a put contract. So you're going to sell it. So the initial one, maybe you sell on the next lower strike price. In this case, let's say you sell at $30 first, and it's going to expire the next month. So the first contract is probably going to expire in February. The same thing, we're going to look at something that actually allows you or give you a premium at least a 2% ROI. So if you based on a $30 strike price, we're looking at least on a 60 cents premium collection, right? So every time when it hit there, the price will go up. At the end of the expiry, your put contract will expire worthless. So the next month or the following month, when actually price came back down to the support level, you start selling it again, alright? Because it's on an uptrend, price generally will hit a lower low, a higher low, and keep bouncing up and up and up all over the time, right? So what we want to do is actually when hits here, continue to bounce up and get up. By the time every time we expire, the price are generally higher than your strike price. You will be collecting the premium because the contract will expire worthless. So it becomes a healthy way of creating a cash flow for you month after month. When the price get higher and higher, and you just collect the premium, collect the premium, collect the premium, right? So that is one of the way to actually help you to actually do this kind of strategy using the put contract. Alright, of course, doing this strategy, every investment you need some form of capital. So what kind of capital outlay actually are we looking at? Right. So remember, by the definition of put contract, as a buyer you have the right to sell. As a seller, you actually have the obligation to buy at a certain agreed price. Right. So as a put option seller, actually what you actually need to do, you actually need to have a cash capital upfront, and that is why this strategy is called the protective put option. You get yourself protected by having the cash that is actually required to exercise this option. Alright. So how much cash do you need? Okay, you basically just need this amount of money by calculating using this formula. Okay, whatever strike price that you can choose from, multiply by the number of contract that you are doing and multiply by 100 shares, right? So in the previous example for the Coca-Cola case, remember, if we're going to do a strike price at $30, assuming we are doing one contract at 100 shares, basically we need a $3,000 capital for us to actually execute this sell put contract. Alright, pretty straightforward, pretty simple. You just take the strike price times the contract times the number of shares. Alright, okay, so a quick summary. So this short video is just basically going to cover with you about protective put. So the whole idea for using this option strategy actually allow you to buy below the market price, right? Okay, or secondly, it helps you actually create a form of money passive cash flow month after month. Okay, so of course, not to forget, you need to work out this capital, because you will not actually want to sell the put and be exercised when your account doesn't have enough money. Alright, you will either get into margin call, or the broker will start calling you. Alright, so how to actually calculate the capital needed? Basically, you just take the strike price, multiply by the number of contract you're doing, multiply by 100 shares, because every contract is referring to 100 shares. Okay, alright. So I hope this simple strategy is useful for you, because it has created a massive amount, or at least a good monthly cash flow system for me. Alright, so I really hope that actually it works well for you as well, so that you can take it as a new way or new source of income for you to actually generate passively month after month after month. Alright, okay. So thank you. I hope you like this video. I hope this video is useful. Alright, thank you, and appreciate that you watching this. If you haven't subscribed to our channel, please remember to do so. If you find that your friends might be interested to learn how to actually create multiple source of income, might be something that interests to them, you might actually want to refer them to this video for them to watch and understand about it. Alright, okay. So thank you very much once again for watching. Alright, I wish you a good day, and I'll see you in the next video for the next option strategy. Bye bye.